please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
This hour, in a bid to end SGX Nifty and Sensex futures trading in Dubai, Indian exchanges have come together and issued a joint press release. Henceforth, they will not provide data on Indian indices to foreign exchanges. We have Vikram Limaye joining in, MD and CEO of NSE. Mr. Limaye, thank you so much for joining in. You have already come on the channel and given us a background, but tell us what sparked the move.
I've said this before as well. That there has been a concern about liquidity moving to offshore jurisdictions, which is obviously not good for Indian markets. And therefore, I'd said this, I don't know when it was, maybe it was 10 days ago, that there are various options that are being considered to see how we can consolidate liquidity in India. So if you look at what we have outlined is a series of things that will try and consolidate liquidity in Indian markets rather than fragmenting liquidity.
If you could just take us through some of the details, Mr. Limaye, in terms of the impact, and if you could just quantify this for us to help us understand this better.
See, broadly, it has two components if you look at it. One is about licensing of indices that may be used for trading and settlement of offshore derivative contracts. So that would include our license with Singapore for the Nifty. That's one set of restrictions in terms of what exchanges are able to do. So therefore, we will have to terminate our license with SGX for the Nifty. That obviously will go through its own termination clause and notice period, etc., per the agreement, which in our case with Singapore is 6 months.
Okay.
The second aspect of what we have outlined is sharing of data in terms of the end-use restriction being for trading or settlement of offshore derivative contracts. So what we don't want is other types of offshore derivative contracts, and that would also include the likes of single stock futures that was announced by Singapore, where the prices are obviously of Indian securities, and those prices are being obtained from Indian exchanges, but could be from multiple sources. So exchanges could give data to other data vendors who might provide it to exchanges, etc., etc. But whichever source is getting data from the exchange, what we are saying is that that data cannot be used for trading or settlement of any offshore derivative contract.
Okay. Mr. Limaye, I just wanted to know, would we be outliers in doing this? Or is this par for the course? It will stand scrutiny in international standards?
No, I don't think there is any question of being an outlier, because the reality is that this is a commercial contract between an exchange and any other exchange, or between an exchange and a data vendor. And you can certainly put restrictions surrounding what someone can do with data, or restrictions surrounding, nobody can force us to license our index, right? It is up to us whether we want to license it or not.
Fair point. So, do you think that this can be circumvented in any fashion, and some kind of derivative products may nevertheless be offered?
We hope not, because I think we are quite clear in our press release about the restrictions surrounding the end use of data for pricing any pricing, trading, and settling any offshore derivatives contract. If people end up finding a wire meter to try and do that, I'm sure that we will take a look at it if this were to happen, and see what else is available for us to try and control that situation. Because ultimately, please understand, the objective is to try and consolidate liquidity in Indian markets rather than fragment liquidity.
No, I absolutely understand the intent, Mr. Limaye. Just a final question. My colleague Prashant is just joining in. When does this kick in? Like, when do we see the last trades in SGX Nifty?
So, like I said, our contract with SGX for the Nifty has a 6-month notice period. So that is, we will have to give a notice period before we terminate, but that's the notice period for our SGX Nifty.
Mr. Limaye, hi, good evening. Just a couple of questions. So can trading in single stock futures really be stopped? Because unlike the Nifty, which is essentially licensed, stocks are not really, those codes are not really licensed to any particular organization, right? Can that really be stopped by action from you and other exchanges?
See, what we've outlined is the sources from, what we've outlined is that the use of data right? And to price any single stock futures contract, you need a settlement price, you need data. You might also need an intraday price on that security, right? That data has to be obtained from somewhere.
Right.
Okay. Ultimately, the prices of securities people are able to get from the exchanges. Now, whether they get it through market participants, they get it through data vendors, or they get it through any source, it is generally data that the exchange is providing to somebody.
Correct.
So all our arrangements for data sharing will build in this clause that this data cannot be used for pricing, trading, or settlement of any offshore derivative contract.
Right.
So a data vendor will obviously have to build in that restriction if he is on-selling that data to any user of that data, that he cannot use it for any offshore derivatives contract.
Right. Right.
So legally, we believe that there will be a restriction in terms of end use of this data for pricing, trading, and settlement of an offshore derivative contract.
Fair enough. Mr. Limaye, the SGX Nifty as a product is extremely popular. Could you tell us a couple of things? I mean, what was the licensing agreement? I mean, what is the revenue that you made via this agreement with the Singapore Exchange on SGX Nifty, the product itself? I mean, for example, last year.
Yeah, we don't get into specifics of details on every licensing product and all that. I think all I can say is that it is not a material amount relative to the objective of doing what is right for Indian markets and making sure that liquidity consolidates in the Indian markets.
You know, the start to the single stock futures in Singapore actually was very tepid. Maybe it is because of the current market conditions that we have, but it didn't really take off with a big flourish. Do you think this move maybe a bit in the extreme, or and why was this really necessary? And it seems like since all the exchanges have come together to do this, there is a push from the authorities for all of you to go ahead and do this as well. Am I right in that reading?
See, I think to answer your first question, obviously single stock futures has been launched by Singapore only about 5 days ago. It was on Monday. So it takes time to build any liquidity in any new product. Okay. So obviously if liquidity hasn't built in 5 days, it doesn't mean anything. The broader point is that what we are trying to do is to make sure that we have appropriate framework in place so that liquidity doesn't move offshore. And if there is liquidity that has already built offshore, that we figure out a way to bring it back. What we have also done, which is important to note, is that we don't want to constrain flows into India. Therefore, we are saying that we will continue to share data with any index or anybody who is using that data for raising ETF money, etc., that will flow back into India. So what we don't want is a situation where ETFs are being raised on the back of certain indices. Those indices will anyway be getting data from exchanges. But if those indices are used for raising ETF money, that is certainly permissible, and we will continue with all those arrangements.
Do you think
coming to your last point about whether this was a push by a regulator or et cetera, as I said, this has been a conversation that has been ongoing. I think we are all aligned in terms of what we need to do. That is in the best
when you say conversation has been ongoing, conversation between Finance Ministry, SEBI, exchanges, should we assume that?
I can't get into specifics of who we had conversations with, but you should assume that obviously what we have initiated will be with the full understanding and knowledge of SEBI. We will not come out with things of this nature with SEBI being unaware of what we're doing.
Would we see tit-for-tat kind of actions? I mean, for example, we have foreign exchanges trading on the NSE exchange, right? Tomorrow, with this as a precedent in a way, what stops others from doing this here? I mean, if, for example, this kind of go on.
No, I don't think, there isn't any kind of liquidity of any other jurisdiction that is built in India that should result in any kind of action from any other exchange. But, it is well within any exchange's rights or any regulator's rights to try and do what is in the best interests of their domestic markets.
No, we get that, Mr. Limaye. One final word very quickly before we wrap. What would you tell investors who perhaps might be impacted by this?
Whose what will be impacted?
What would you tell investors that perhaps might be impacted by this move?
There is an option available for people to trade in India. So they can certainly trade in India. They can trade in Gift City. There are avenues available for them to continue to trade in Nifty or in underlying Indian stocks.
Yeah. Absolutely. Okay, fair enough, Mr. Limaye. Thank you so much for putting that into perspective. We will have to take a very, very short break on that note. But up next, we will get you all the earnings action of the day. Asset quality worries continue to dog the big public sector banks, Bank of India and Bank of Baroda. SBI reports 23,000 crore rupee divergence in gross bad loans. But the bank chief promises that the bad news is over. Welcome back to What's Hot. Let's get to earnings action now. It's been all about earnings this Friday evening. And here's the two biggest one. India's largest lender, the State Bank of India and Bank of Baroda, both reported their third quarter earnings today. And worsening asset quality concerns seem to be a worry for both the banks. In fact, Lata is doing the number crunching for the last few hours and she's here to decode this. Lata, put this into perspective. What stands out if you look at these banks standalone from an asset quality perspective?
Well, it's actually an all-round shocker for State Bank of India. It's reported a loss. That itself is a big shock, 2,400 crore. The slippages, that is the fresh bad loans, defaulters that you have created, is 25,000 crores. Now, last quarter was 10,000 crore. The quarter before it was 30,000 crores. We were told that all the bad news from all the subsidiaries is in and that's why it's 30,000 crores. Then why 25,000 crores now? So the total gross NPA, gross bad loans, has jumped by 7% quarter on quarter. And the other bad news is that, you know, every year the regulator, RBI, oversees, supervises the books. And what they have found is that last year, according to RBI, 25,000 crore more of NPAs should have been declared, or rather 23,000 crores. So just all around bad news. Is this beaten by growth at least? No. Actually, the loan book has declined quarter on quarter. They've given fewer loans. So State Bank chairman tells us that all the bad news is out and we start a brave new year from FY19. That's the only positive from the results. In Bank of Baroda, it's not all-round bad, so I'll begin with the good news. It's a 40% growth in net interest income. Very good. Though, of course, it's not only because of loan growth. There have been other factors. Margins also are up. So the bank is making more money on every loan it gives. 2.7% versus 2.3% a year ago. The cost-to-income ratio is down, which means the amount of money they spend to create 100 rupee is come down to 39. It used to be 44 1 quarter ago. That's a very good management of expenses. But the bad news is, again, the loans that have slipped into bad category have risen to 5,600 crores. And last quarter, it was only 3,400 crores. So if you thought things were peaking off, they are not. Bad news continues on the asset quality front for both banks.
Okay, fair enough, Lata. Thanks for getting us that quick take on the fine print of these two important public sector banks. With that, we will have to take a very, very short break. But on that note, the Niti Aayog releases its health index report. That story will be up next, where Kerala, followed by Punjab and Tamil Nadu, are the top performers among large states. We'll get you the details on the other side. Welcome back. You're still with What's Hot on CNBC TV18. Now, in a major step towards improving healthcare data systems in the country, the Niti Aayog has launched the Health Index. Now, this index ranks states based on various parameters to find out who are the best and worst performers. Let's start with the best performers. Kerala, Punjab, Tamil Nadu have emerged as the top 3. Gujarat and Himachal Pradesh complete the top 5 as the most healthiest states in the country. The index ranks smaller states separately, with Mizoram topping the charts. Manipur, Meghalaya, Sikkim and Goa are in the top 5 best performers. States in northern India dominate the worst performers list, with Odisha and the only exception. Now in the top 5, Madhya Pradesh, Bihar, Rajasthan and Uttar Pradesh are at the bottom of that pile. We will get you an exclusive interaction with the Niti Aayog CEO Amitabh Kant on India Business Hour to break up the rationale of the ranking. But with that, we are completely out of time on What's Hot. Thank you so much for watching the show. But stay tuned as up next is a special from the Edelweiss Conference 2018. And in 30 minutes, we'll be back with the top stories of the day with India Business Hour. Stay tuned to CNBC TV18.